Hello everybody, welcome to another one of my investing videos. My name is Mark, and in this video I'm going to talk a little bit how to manage your options if you are doing an option caller. And this is my way. The way that I set up my option callers is probably different than almost anybody that you'll ever meet or talk to or watch their video. And the way I do it is I buy the stock and then I buy leap options that expire for the long haul, and then I sell the open not weekly, but short-term call options to give me an advantage in the time decay, the theta. And so let's go ahead and take a look at my position here, and let's go to the transactions, and let me go ahead and put in steel, ticker symbol X, and I'll move this to March, and we'll click the view, and here's my position right here. I bought 200 shares of steel, and the reason why you see two separate orders is because of a mouse error. I accidentally canceled the first order, but 35 shares got filled, so I had to pay double commission. So I wasn't very happy about that, but I got my 200 shares, and it averaged out at $20.66. Then I bought to open two put options, and they are leaps. They expire January 15, 2021. Today is April 18, 2019. So that's still another 20 months from now. And that was on March the 12th that I did all this. And I spent $399 for those, plus commission $806, so about $400 a contract. And then I sold to open two call options, $24 strike price, took in $53. And then 10 days later, I did a little swing trade. I sold to open some $16 puts for $39 a contract, took in $69, bought to close for $50, so made a profit of about $19 and some change. And then here I bought back my $24 calls for $5. So I took in 53 times 2. I took in $97.52, and then I just closed it out on the 10th. That would have been about a week ago. Haven't been doing videos keeping up too well, but here it all is updated. Closed out of those for $10, so I made $87. So, and then just a couple days ago, I sold to open two $16 put options for the price of $21. Took in a total of $33.52. Okay, and the reason why I sold those puts is because for now the bleeding is over until earnings. At least that's my opinion. And you never really know for sure what stocks are going to do. But if we look at their 5-day chart, this is their 5-day chart right here. And even though it looks like big wide swing, this is just one little push up, and then it immediately came back down. But it's been ranging. It flattened out the last 5 days. And if we go out further, this is a month. Okay. Steel was doing a Tom Petty. It was going into the free falling mode, just like Tom Petty. And I bought steel way the heck up here. My dollar cost was $20.66, and that would have been on the 12th of March, which actually that's more than a month ago, so I have to scoot it over a little bit. And the 12th would have been right around here. So I bought up there somewhere, and the $20.66 would be right about there. And now I'm having lots of fun watching the value of my shares tank. So I am in the red, at least for now. But the point of the option caller, it's a long-term strategy that if you manage it properly, you will make money in the long term. And so that's my position in a nutshell. And we can look at it under this window. Okay, these are my 200 shares of steel, now at $16.69. And these are my two long puts. and I spent $399 for those, and they're now worth $535. Actually, the bid is $550, the ask is $575, so they're probably worth like $560. So how would you like to make that kind of money? How would you like to invest $400 and watch your investment balloon up to $560? Well, technically, that's what I was able to do, right? Now, the downside is my shares are down, but that's okay because these puts are good all the way till January of 2021. And now let's get into the meat and potatoes on how to manage this. And so let's go back to my main screen here. Actually, we'll stay on this screen. Okay, so I have my 200 shares. And then I have my collar. I have a put option, which is a contract to sell my 200 shares at $20 a share. And I spent $399 for that privilege. And then I did sell $24 call options. And you saw that I bought those back for $10. And so now I'm out of that. And so now the question is, what do I do? Well, I decided to sell to open these weekly puts. These expire on April the 26th. 2019, and let's take a look at how much I got for those puts. Let me put in ticker symbol X so it narrows it down, and here it is right here. So $21, $33.52. So, but just remember, $21 a contract. That's what I got when I sold to open those $16 puts, and they expire April the 26th, about a week from now. Today's Thursday. Market opens in a few hours, okay? And so, why did I sell to open those puts? Now, when you do a collar, and you're going to manage a collar, and the stock moves up or down, you got to think of a collar like a spread, okay? Now, when you do option spreads, right, and we go to steel, and let's say I want to do a credit call spread, okay? What I might do is I might look at credit calls, let's say 43 days out, okay? And let's go ahead and go to vertical call spread like that. And let's see what we could get if we put in a wide, like a $2 spread. There we go. So, if I believe that steel was going to stay flat or even go down, then I might consider selling a credit call spread on steel. And if I did a $2 spread, that would mean that I would be, and it would be over here, okay? It wouldn't be, this side is the bear calls, this is the bull call. So what I would do is I would click on, let's say the $18 one. So I would click over here, bull call spread. I'm sorry, actually it is bear call spread, forgive me. Okay, it is bear call spread. And I would click on this, and the bid is 44, and the ask is 38. Or I'm sorry, the bid is 38, the ask is 44. And so I'd click on it like that, and then I put in my vertical call spread, and this is my premium right there. And so I'd probably put in like a low number. Maybe I put in 40. Maybe I put in 40 cents like that. And then I put in the number of contracts like that, let's say 1. And then I click the review order button, and I would get $40, right? And it's actually a debit. So actually, I guess I did mix it up. I should be doing the other one. But the point is, let me go back to the option chain. I'm not going to place the order here. I'm going to go back to the option chain here, and back to my vertical call spread like this, and go back to my $2 width. Okay, so my spread is $2, right? And I'm hoping that that steel trades below $18, and if it does, then I'll make this premium. Now the way that works is I would sell to open the $18 call. And the $18 call, the bid is 59, the ask is 63, so let's say 60 bucks. And then I would buy to open the $20 call. The bid is 19, the ask is 21, so 20. So that leaves a $40 difference. And so if indeed steel trades below $18 a share, then I would make the difference. I would pocket it because I'm selling this. I'm going short this $18 call and I'm going long this call. So that creates a $2 spread. Okay, and so my risk is that $2 minus the premium, which is $40. So I'd be risking $160 if steel went up to $20 or higher. Okay, that's kind of how an option collar works. Now, let's go back to my position. Now, an option collar is not a spread because you're buying shares of the stock, but it's very similar in that you have an upper limit and you have a lower limit. In that credit call spread, $18 was the lower end and $20 was the higher end. Now, in this situation, I bought 200 shares of steel. My dollar cost average is $20.66, so that's my upper limit. Then I bought to open these two put options. These are my $20 put options. I spent $399. And so that creates my lower limit is $20 minus the $399, which is $16.01. And I round it down to 16 because there's no such thing as a put option with a $16.01 strike price. So that's my lower limit. So my upper limit is my dollar cost average, $20.66. That's what I spent for the 200 shares, and my lower limit is the $16. So I take the $20.66 and then I subtract the $16 and I get the $16.01 and I get $465. That's a debit. That's my maximum loss right there. The most money that I can lose is $465 per 100 shares. So I did 200, so I could technically lose 900. Let's see, 465 times 2 would be $930. Now, that $930 got reduced because I sold to open, let me narrow this down again, I sold to open, let me go to March, boy oh boy oh boy, and put in the view like this. Okay, here it is. I sold to open these calls for $97.52 and I closed it out for $10, so $87.49. So let's just say 80 bucks. Let's say I only made 80 bucks, okay? Now, I can subtract that from the $965 risk. So 965 minus 80, my risk is now reduced down to $885. And I also get to reduce my risk by this little swing trade. So 885 minus 20, let's say, $865. Now I just sold to open these $16 puts. Okay, so if I make, let's say, $30, then my risk goes down to $835. Okay, and so I'm always working and working and working, trying to reduce that spread down to nil, trying to get rid of that $465 risk. So option collars work kind of like a spread. It's not a spread because you're buying the shares, but whenever you set up an option collar, you have a maximum risk and you have a break even, and you also have a profit target, which in my case would have been the $20.66 plus the $399, so it would have been $24.65. That's why I sold the $24 strike price, because if the price of steel did go up that high, then my shares would get called away, but I'd make very good profit on the value of the shares. Well, that didn't happen, okay? Steel went into Tom Petty free falling, and it's down to where you see it now, $16.67 a share, right? But I can go to bed at night and I can sleep like a baby with no stress, because I still, these put options that I bought to open, these $20 puts, they don't expire till 2021, okay? And these $20 put options right now, you see that they were worth $399, right? But if you look at their value now, they're all the way up to 500, and the bid 550, the ask 575. So 399 went up to 550. So if I wanted to, I could sell to close these right now and make a nice $160 profit. How would you like to make $160 profit on a $400 investment? That's a 40% return, right? But there are three things that you can do to try to reduce your risk. Okay, and the first one I already explained. You sell to open call options. I did that. Well, now steel has dropped so low that if I were to try to sell to open call options right now, let's go ahead and take a look at the option chain. Okay, and let's say, okay, so this is May 17th. Okay, this was my former covered calls, the $24 calls that I bought to close. Now, if I were to sell some more calls, let's say I go out another couple of months, I go out from 29 to 92. That's another 2 months, right? And what strike price am I going to sell? I have to go out of the money, and if I were to try to sell the 24s, I only get 10 bucks. If I go down to 23, I get 14 bucks. If I go down to 22, I only get 20 bucks. Okay, that's not enough money to pay off my position, right? If I have to make 465, I have to make actually the 900 and whatever dollars, which is now down to $830, right? I have to make $830 between now and the next 638 days. Okay, so that's another 20 months. So if I have to still make $800, that's like 80 bucks a month, right? Or actually 40 bucks a month, because 20 days. So obviously I can't sell this $23 call and only make 14 bucks a month, right? I got to at least sell the 22s, and if I were to sell the 21s, that'd be better. If I sold the 20s, then I'd be making 47. But what happens if steel goes over $20? Okay, what if steel goes up to 21 or 22? Yeah, I made $47, but I would lose if steel went back up to $21 or $22. I would lose $100 or $200 in intrinsic value. So it's not worth it for me to continue to sell cover calls. But that's the first thing that you can do to manage your risk on a caller: sell covered calls. Now the second thing you can do is what I'm doing: sell puts, sell to open puts, and I've been doing that. Okay, and the reason why I'm selling to open these, oh boy, let me put in steel here so we can see all this. The reason why I'm selling the $16 puts is because that's my break-even price. I bought to open those $20 put options, and I spent $399. So if steel goes to $16, then I break even on the trade. If it goes to $15, I make $100 profit on those $20 puts. Now the problem is I own shares, so I lose money in the shares. So my number one goal is to get rid of that spread, that $465 gap that I explained. And so I have all this time to do it, right? If we go to my positions, these are my puts. And I have from now until January 2020, I have 16 months to make back the money that I spent, the $399 a contract. And I've reduced it a little bit, but I still got a ways to go, right? And so these $16 puts that I'm selling to open, and back to my transactions here, these $16 puts is going to make me another $33, and so that averages out to about $16 a contract. And notice that these are April 26th. Now my call options that I bought to close, that was in May, right? And so if I make this money, this will put me very nicely up. This will put me nicely ahead of the game. And then by the time May 17th rolls around, and a little side note here is that steel has an earnings announcement coming up, and it is on May the 2nd. And so that's the reason why I wanted to sell short-term puts. Okay, the $16 puts expire the 26th. That's before earnings. Okay, I don't want to sell $16 puts that expire in 2 or 3 months, because if steel has a bad earnings and it goes down to $12 or $13, then, you know, I'll tell you, man, I'm going to feel like a dunce. I'm going to say, what the heck am I doing, you know? So the safest thing for me is to sell open these puts, okay? Now, the third way, and I can do that anytime, is from now until they expire, is that if I'm up a profit on my long puts, and we go to my positions here, these puts, if I'm up a profit, right, and the bid is 550, the ask is 575, I can sell to close these for, let's say, 560. Now, I spent $3.99, so that's $160 profit. That means that profit can lower my dollar cost average, which is $20.66. And so that lowers me down to $19, and then I can take that money, okay? And so if I sold to close these at 560 times 2, that would be $1,120. I could take that $1,120. I can go to steel like this, and then I can take that $1,120 and I can buy some lower puts. And boy, I'll tell you, man, it's a major temptation for me, okay? When I look at these puts, okay, I can take that $1,120 and look at these $15 puts, okay? The bid is $270, the ask is $282, so let's say $275. For $275, I could afford to buy 3 put options. I could buy 3 of these $15 puts, and if I spent $275, $550, I could afford to buy 4 of them. So if I spent $275, $550, $725, would that be $1,000? No, it'd be like $1,050. I could take that $1,120 and buy 4 of these puts. Boy, I got to look at this. Okay, I'm going to digress here, and I'm going to go to the Greeks. I'm going to look up the delta. Okay, and I really want to look at this delta. So let's go to 2021, and let's click on the put like this, and view the chain like that. And let's take a look at the delta on these long-term puts. Okay, so the delta on the 20s is 49. And then the delta on the 15s is 30. Now, if I bought 4 of them, that would give me a higher delta. That would give me a delta of a -60 versus a delta of a -49. So it's a done deal. Now, I'm not going to do it now, but I have found a nice opportunity of myself right in the middle of doing this video. I could take that $1,100 whatever dollars. I can buy 4 put options, okay? And since I have 200 shares, then I divide it, and I basically I'm able to double my delta on that. Okay, let me check this one more time. Let me go to the Greeks and view the chain, and let me go to the puts like this and view the chain, and here it is. Okay, so delta on the 20s is 49s. If I got 4 puts, then that means I'd have a 60 delta. That would increase my delta by 11. So I found an opportunity to myself. Now I'm going to wait. I'm going to wait because the steel earnings is coming up. I want to do it now because I think steel is going to stay flat until the next earnings. Okay, steel tanked. It went down because of their lower credit ratings, and I think steel is plateauing. It's flattening out. But on May the 2nd, okay, that's when things are going to get different. And let me close this video out by looking at the chart here. Let me put in a 1-month chart, and let me move it up a little bit. So May the 2nd. Let me close out this. May the 2nd would be, let me put in my drawing tool. May the 2nd would be right here somewhere. Okay, and that, let's see, today is the 18th, Thursday. So 25th, so that would be near the end of the week. So that would mean maybe on a Monday. Maybe on Monday or Tuesday I'm going to do this. But to me, and you can leave a comment in the feedback. What do you think? Does this sound like a good way to adjust my collar here? Right now, my puts are, I'm up pretty nice on my puts. Okay, I spent $399 for these $20 puts, and they're worth $535. So if I close those out, I bought 2 of them. That means that I would get $1,070. Actually, the bid is $550, the ask is $575. So let's say I get $560. I get $1,120. Would that be an interesting and a profitable way to give me an opportunity to make some good money and keep some profit? What do you think? Go ahead and leave a comment. What I'm thinking of doing is selling to close those puts, lowering my dollar cost average, and taking that $1,120 and buying 4 of these, because the bid on the 15s is $270, the ask is $282. So let's say I buy them for $275, $550, $725, $550, $725. Let me get a calculator here, so I can get an exact number. I'm doing this on my phone here. 275 times for $1,100, and I'm getting $1,120. So I'm basically transferring my risk to these $15 puts, right? But look at the delta. Okay, the delta here, the Greeks. Let's look at the delta. Okay, and let me click in the put, and we'll go to the leaps here. Okay, so the delta is 50 on this, and then if I got 4 of these, right, that would be a 2-to-1 ratio, because I have 200 shares, but I'd have 4 put options. That means I get to double this. That gave me a 60 delta. So I would raise up my delta for the same amount of money. So if steel had a bad earnings, then I could even potentially make a profit if it went down. If steel had a good earnings, I'm not risking any more money on the upside. I've already bought to close my covered calls. What do you think, huh? Does this look good? Leave a comment here. Tell me what you think. And I hope you enjoyed the video here. The option collar in a nutshell is you buy a stock, and then you buy to open put options. And that way, if the stock goes down, the put options value will go up. So you don't lose a lot of money. And then you got to try to think of ways to cover that gap, that risk. Okay, my risk $465, and you can do that by number 1, selling calls, number 2, selling the open puts, and number 3, just flat out selling to close your higher puts if the stock indeed does go down, like steel did, and then buying to open some cheaper puts. So tell me what you think. Leave a comment, and I hope you enjoyed this video. And as always, hit the like button, whatever you want to do. I appreciate anybody's support. Thank you for watching, and I will see you in the next video. Have a good day.